Well, the government's boosted homeowners grant and sliding interest rates, there's now enough bait to lure first home buyers into the housing market. What about the top end, though, of the market? To find out where high-end property prices are headed, I'm joined in the studio by Justin Doobov from Intelligent Finance. Justin, very nice to have you with us. Of course, we had always believed, hadn't we, that end of the market, the upper end, was always immune from the ebbs and flows of house price dips. Where are we at?
Well, you're absolutely correct that was the market's perception, and a lot of the high-end market had their money invested in shares, and they've taken a huge hit. On the other side, from employment, a lot of them were employed in the financial sector that earned a salary that was a strong salary and a massive bonus. Those bonuses aren't going to be there. Their jobs may not be there, and next year they may even get a tap on the shoulder if they haven't lost their job already. May get a tap on the shoulder saying they're not going to be there next year.
What bracket are we really defining here in terms of price, where we've seen things that previously were stable now wobbling?
Probably $2 million plus, and then as you get higher, $5 to $10 million, $10 million plus, those sort of properties that if someone's in financial difficulty, normally they could sell them. There was always a buyer to buy them. Now those buyers aren't there. That market's dried up, so therefore the prices have come down.
What do you make, though, of still these records being sent, Justin? We've heard one Hyde Park in central Sydney, opposite Hyde Park, $20 million sold pre-sale. That's surely there's some stability up there. That's an exception, not the norm. So while a lot of agents will go around ringing the bell when they make a good sale, there's a lot of sales that are made that are sold well below the reserve price. Well, indeed, because the entry level to get into that block is 1.8 million. So what would you expect to see in that region in terms of price movement?
If it doesn't sell in the next 3 months, and our prediction is the market's going to come down a little bit, you probably might get 10% saving off that price, even 15, 20%. So,
are you seeing, though, these sorts of things potentially getting scuttled, though, as a result of the current environment, that a developer would just have to walk away and say, my margins are such, that I just can't make it work?
For new developments, yes. What we're seeing is for existing developments, they may have 20 properties in the development, and they might sell 5 or 10 of them at fire sale price just to get the banks off their back, and they may hold the other ones until the market improves a little bit.
A lot of controversy, Justin, over prices in terms of historical trends, looking for those when you're going out there to bid on a property, and being gobsmacked that actually things are going way higher than agents have led customers to believe. Where are we at with that?
Well, you've said two things. One thing, with agents are leading clients by underquoting. That's also a bit misleading, because the vendor wants that price, the agent quotes this price at the door and hopes to hell that somewhere in between they're going to meet. But previously, historical sales, you were correct exactly in saying that historical sales were the ideal way of measuring what the new price of what a current property is going to sell for. The issue now is that as the market's been coming down, that what something sold for 3 months ago, and then 2 months ago, 1 month ago, the prices are coming. So you can't really use historical information for a recent sale, for what a recent property will sell for. And the other factor is you may have two properties side by side, let's say two $5 million properties. One may have a vendor that can afford to wait. They're not time critical, they haven't lost their job, they're not in financial difficulty, and they can afford to hold it. The other property, that person's in financial difficulty, and that might sell for $4 million, not the $5 million asking price. So it's more so, it's not so much historical data, it's how desperate the vendor is to sell will determine the price now.
Advice in terms of determining price to expats now, cashed up expats coming back to this market, Christmas Eve, what do they do? Do they put an offer in, or do they wait until January believing that prices will go further south?
I think, well, if they're right here now, I'd be looking at putting an offer, so long as they're educated in the market.
If they're cashed up now?
Cashed up now, ready to go, put some offers in, because...
Why not wait?
Well, the longer you wait, then you can do either. But I believe put an offer in. If you think the property market's there, put a low ball offer in. Let them sit over the Christmas period thinking about that offer. If they don't want to accept it now, let the vendor sit over the Christmas period. Chances are, after 1 month of the whole property market being closed, and they start to think about their finances, and if it looks a bit grim, chances are they'll accept it.
All right. 6 to 12 months an outlook for 09. Where are we going to go?
6 to 12 months, I still think it's going to be a bit shaky. There's a lot of people that haven't lost their jobs yet. There's rising unemployment. The banks have tightened up all their lending criteria. That's one of the key things. Even if someone had a job, was ready to go, had their 20% deposit, if they're looking at buying a $5–10 million property, the banks aren't there. There's been a whole consolidation, so you can't go into a property with a 20% deposit. Now you'll need a 30% deposit. So even if you're ready to go, the lending criteria has changed, so therefore that's going to put downward pressure on property purchase prices. So where it's going to go, I'd say for the next 12 to 18 months, it's still going to be a bit shaky, but then after that I believe the market will keep going up. So my advice to clients is create a cash buffer, so as much as you can, save as much money as you can, either in your offset account or back in redrawn the loan to take care of downtimes like this. But if you can ride it through, or if you were to buy a property at a bargain basement price now, in 5 years' time you'll be looking back laughing at how cheap you got that property.
Wish I would have done that moment for you this year. What was it?
Wish
I would have done that.
Well, it's actually wish I didn't. Actually, it was an underbidder at a property that that now probably, if I were to buy that same property, it's come down $200,000.
Right.
So it's wish I did. It's glad I didn't, and glad someone else put their hand up higher.
Justin, pleasure. Many thanks.
No, thank you very much.
Justin Doobov there from Intelligent Finance. Okay.